Hello, I'm Jen Kohls, Associate Wealth Advisor here at Richardson Financial Group. I'm joined with Dan Brown, our Director of Investment Management, and we'd like to provide a second quarter recap of 2022. So Dan, the second quarter was a poor quarter in performance of the financial markets, including stocks, bonds, and even some commodities. What contributed to this poor performance?
Sure, Jen. The factors that we saw in the first quarter that led to the weakness carried over and persisted into the second quarter. So just to walk through some of those factors real quick, inflation, namely, is still too high. In fact, inflation actually accelerated in the second quarter from the very high levels that were around in the first quarter. And because of this, we saw a change in Fed policy. And then we also saw, ongoing geopolitical concerns, namely with the war between Russia and Ukraine. So just to circle back on the stock market for a second, the weakness was very broad, probably some of the broadest weakness we've seen in a long time. And the broadness persisted throughout market capitalization, so size of companies didn't matter, geography didn't matter, and we also saw weakness really across all 11 economic sectors. Probably for the first time in a long time that we can remember that we saw all 11 sectors lower during the quarter. And the weakness also persisted into the fixed income markets. So we saw throughout the quarter that interest rates rose, which pushed bond prices down. And again, the weakness was very broad. Didn't really matter which category of fixed income you were invested in. There was negative returns. And then we also saw some weakness in certain commodities. The one positive factor we did see develop towards the end of the second quarter is with the emerging markets, and specifically with China. So they've kind of pulled back on their zero COVID policy, and they moved to reopen a number of their very large cities. And again, we saw that was a positive development.
Dan, let's expand a little more about the Fed's policy. More specifically, what's changed about their approach this quarter?
Sure. So we saw the Fed in the second quarter to adopt a much more aggressive approach towards monetary policy, and specifically raising the level of Fed funds interest rates. So, and this is a direct response to the higher inflation that we saw in the second quarter. So the first graph we're showing is the fact that CPI, Consumer Price Index, accelerated at an 8.6% year-over-year growth rate. And this is just unacceptably high to consumers and the Federal Reserve, and they feel pretty strongly they can bring that level of inflation down by raising the level of interest rates. So we've now seen 3 increases from the Federal Reserve for Fed funds interest rates. The first one was back in March, which was a quarter-point increase. In May, we saw a half-point increase. And then in June, we saw a 3/4% increase. So we now have Fed funds sitting at a range of 1.5 to 1.75. And we saw interest rates in the broader economy also follow that level of Fed funds higher. So for example, we saw the US 10-year Treasury security peak out with an interest rate of about 3.5% in June. And then as this relates to Fed funds, we're showing a graph here, going back to about 1990, and you can see the pace of increases this time around for this cycle is much more aggressive than what we've seen in other cycles, where the Fed took a much more slower approach to raising interest rates. But now with inflation as high as it is, they really can't afford to go slow. They need to go fairly fast and fairly aggressive, which they're doing. The one tricky part here is, the Fed wants to achieve what they refer to as a soft landing for the economy. The economy was, pretty strong in 2020 and 2021. And now they think they can slow the economy down to a point where it doesn't tip the economy into recession, and that's kind of the dangerous part here. And even if we do tip into a mild recession sometime here later this year, early next year, we think that stocks have largely discounted us actually going into recession. So with the stock markets, down 20 to 30% so far this year, we think they've actually priced in a very mild recession.
Well, Dan, with all that said, what is the Fed's desired outcome with this more aggressive approach?
The Fed has clearly stated their desired outcome is to slow the level of demand and economic growth in the broader economy. And so far, so good. We're starting to see some signs of success here. And we have to look no further than the housing market to see that mortgage rates have almost doubled from where they were to begin the year. And this has led to a slowing of economic activity. And also we see housing prices just starting to roll over, late in the second quarter. So far, so good with their with their plan of just slowing economic growth just enough to bring inflation down.
With those updates in mind, Dan, what message do we want to convey to investors?
So probably the biggest message we want to convey is just that at this point in the cycle, patience is going to be required as the financial markets work through these number of headwinds. So the first thing we want to remind people is that just because we've entered bear market territory from a stock market perspective doesn't mean we'll enter recession. So we look back at the last couple times that we had bear markets, so namely the fourth quarter of 2018 and also the fourth quarter of 2011, where we had 20% sell-offs in the stock market and didn't enter a recession. We're thinking this time around is going to be the same. And Jen, the other thing that we're paying attention to is second quarter earnings season, which will begin here shortly. So we think expectations for second quarter earnings are still a little bit too high, given all the higher price levels that companies are enduring. So we think before we bottom here, from a stock market perspective, we're going to need to see inflation roll over, and we also think earnings expectations need to come down just a bit.
Thank you, Dan. And thank you to our viewers for watching. If you found the information in this video helpful, please click like and subscribe.